Of everyone who got to go to the regatta. But if you've ever wanted to invest but felt overwhelmed by all of the different investment terms, mutual funds might be the perfect starting point. But like any investment, there must also be risks to consider, right? So how do they work? And how do you choose the right one? Well, here's the breakdown.
Investing in mutual funds is like joining a financial team. Your money is pooled with other investors and managed by professionals who decide where to invest. But before diving in, it's important to understand the different types of mutual funds and how they fit into your financial goals. There are several types of mutual funds, each designed for different risk levels and investment strategies. Cleara Farquharson, VP of Business Development and Client Relations, explains.
An equity fund invests mostly in stocks and shares. Over the long term, they will generate the highest rate of return, but in the short term, they can be very volatile. Bond funds invest primarily in bonds or fixed income securities, and while the rate of return is less than that of an equity fund, so is the risk level. Balanced funds invest in a mixture of both stocks and bonds and provide a perfect balance between risk and return.
So why do investors choose mutual funds? The benefits include diversification, professional management, and accessibility. But like any investment, there are risks too.
Some of the risks of investing in mutual funds include market risk. The value of mutual funds go up and down according to market conditions, and this is especially true for bonds and stock funds. Second, professional risk. The overall performance of mutual funds are determined by the professional money managers, and sometimes they don't make the best decisions. Third, fees. Mutual funds charge investment fees, and these over the long term can actually reduce your overall return that you will generate from the funds. So it's important to remember and look for and ask about the fees that these mutual funds charge.
Now, how will you choose the right mutual fund? Farquharson says it starts with knowing your risk tolerance, checking a fund's past performance, and looking at the fees involved.
First and foremost, you want to ensure that the investment goals of the mutual fund are aligned with your own. So for instance, if you have a long-term perspective, if you're going to, for instance, saving for retirement or buying a home, you want to invest in an aggressive or an equity fund.
Whether you're saving for retirement or just starting your investment journey, mutual funds can be a great way to build wealth over time. For the Bahamas Tonight, I'm Diane Dorset.